How's it going, guys? This is Top Down with TCM. You already know us. I'm your host, Azaan Barlas. I'm with Weston Weinberg and Jason Cruz. And we're here with two special guests today. We have Danny Prichard of the hardware sector and Kenneth Wolin of the energy, industrials, that whole sector too, from TCM. So, Danny, would you like to introduce yourself a little bit?
Yeah, so I'm Daniel Prichard. This is my final semester at Cal State Fullerton and part of the Titan Capital Management program. And it's been pretty interesting being on Zoom for the past couple semesters like this. But yeah, excited to finish strong. But yeah, I've learned a lot in TCM, learning about just kind of like the basic work ethics, being with classmates, colleagues, reporting for clients, doing equity research, and always being on top of the markets, discussing the markets. And it's just, preparing us for the, the professional life and industry. So, yeah, it's been pretty great. And that's kind of just where I'm at right now.
Nice. We've definitely encompassed a lot this year in TCM. And Daniel
Yeah.
was being a little humble. He's also the PM of the quant portfolio as well.
Yeah, that's been brand new. Definitely a pretty big learning curve. Kind of just dumped on us. Yeah, try to make a programming strategy, based on a thesis, an investment thesis. So my colleague Edgar Lucatero, who's already been on the podcast, he is the R guy, I'm the Python guy, and really no guidance or direction on how to do it. But it's coming along, and hopefully it's something that will be instilled in TCM, and that future candidates or people are in TCM that apply for it have the interest in programming and carrying on what we're trying to establish of managing a quantitative strategy. So
Nice. We're definitely going to talk to you a little bit more about your sector, hardware in a bit. But first, I would like Kenny to introduce himself as well, like his sector and everything.
Yeah, hey guys, thanks for having me on. I'm actually pretty excited to be here. My name's Kenny Wolin. I'm in my 5th year of college. I'll be graduating in fall of 2021. That's the year we're in, yeah. I'm really happy to be in TCM, actually. I almost didn't apply when the opportunity came around. It was a very last minute thing for me, but I'm very happy I did it. Even though we're in Zoom, it's been still a great experience, like Danny said, and we have learned a lot, and it's definitely made me, I think, made me a stronger worker, as well as feel more confident within the world of finance. In TCM, I cover industrials, materials, and energy, like Azaan mentioned previously, which is seems like a boring sector or sectors, but there's a lot going on, from oil drilling to solar to airlines to transportation and shipping to materials and commodities. And there's a lot going on all the time, and it's a very dense sector and sometimes overwhelming. But it was a lot of fun learning at the same time, because I wouldn't have done it if I wasn't assigned to that sector. And then on top of that, I am the co-portfolio manager for the equity team for the semester, and I've been enjoying that. It's been actually a great experience too, having to talk with co and some of our directors more often that I wouldn't have done last semester, just being a regular analyst. So that's been a nice opportunity. And then actually, not too long ago, I tried teaching myself R through data camp, because Professor Kim gave us access to like the website. So I've been doing that on the side, just to see if I'm up to the challenge. I know, Azaan, you do a lot of coding. I see you talk about on LinkedIn. But I thought no, but it's good. It encouraged me to step outside my comfort zone. I have a little bit of experience in C from when I used to be an engineering student. So hopping over to R wasn't the biggest struggle, but it was still something I think it's a good skill to have for our industry, just because it's always so competitive. But I'm happy to be here, and I'm excited to talk with you guys today.
Now, Kenny, it's interesting that you mentioned that you used to be an engineering student. I actually did not know that. So I was wondering, what was it that like guided you towards the path of finance? And Kenny, after you answer this, Danny, you're more than welcome to jump in and talk about what got you interested in the field of finance.
I think for me, it was, well, I was originally in engineering because I like being hands-on and I like understanding how things kind of work inside and out. But what drew me to finance was the business world and how like the world just kind of revolves around money. And not to say that in a, I guess in a negative tone, but how things are kind of connected and intertwined, and you know how one thing across the world or like an interest rate here or what's going on with this company can really, you know, affect things. And that's what really kind of caught my attention. And on top of that, I think I just like investing. I've always thought of being financially literate as a important skill, that it's something we're not taught early enough. So I would go outside my realm of engineering at the time to teach myself that, which brought me closer to switching majors. So that's how I ended up here, and I couldn't be more happy with my decision.
I have been working in a small accounting firm for a while, public accounting, doing personal and business taxes, and I've done bookkeeping and I prepared some business tax returns, and I've always been really interested on like how this company operates and how sustainable they are. You know, they are a service, you know, providing to a bunch of people, and I just dive like right into their financials, and then it's kind of just, you know, our business helping other people. I've always been like service oriented, so I kind of wanted to do the same thing in finance because it's both a tax and financial office. So I want to help people. As Kenny said, like it's good being financially literate, but helping people become that same thing and kind of like get a grasp on, you know, what they should do with their money, or how they should kind of, you know, structure their business in a way that makes them profitable, I think is really, really interesting. And that has motivated me to, you know, get into hopefully, you know, like asset management or business consulting. And so it's ultimately just to help the clients, you know, become, you know, successful in their financial goals. And I think that's such a great thing to see. And it does happen.
Yeah.
So, yeah.
Yeah, I agree with you, Danny. I think being financially literate opens a lot of doors in terms of helping people. And I think it can be a tough topic for some people because it's not that they're not smart enough. I think it's just sometimes our own ignorance, or we haven't been given the opportunity to learn. And you can really help, you know, change a lot of people's lives for the better if, you know, if they're willing to learn, or you have the opportunity to shine some light on things that otherwise they wouldn't have known.
Yeah.
Because money is a really powerful tool when used the right way, and you have the knowledge and the experience to kind of guide yourself there. And I think that's kind of why I switched from engineering to, you know, finance as well, is because as much as you will be an associate for a business that, you know, moves a lot of money one day, you kind of want to know how the game works, so you can you know, take advantage of it to the best of your ability.
Yeah, I agree. Investing can be a very, very powerful tool, especially like, I don't know, like even at the surface level, like if someone, you know, instead of investing in a savings account, they dump it into like an index fund, you know, that tracks the market. I see Weston smiling, but you know, it's a very simple move like that can like reap huge return overall. But anyway, transitioning away from this topic, I am going to steal your question, Azaan, and I'm going to ask Danny about his options trading strategy. So at a very like base level, because I don't understand technical terms past options. What is your sort of strategy when, you know,
choosing what options to, I guess, trade? One of the things I look in at options on a weekly basis, just the amount of volume. Because if you see volume on the option, that means there's lots of activity going on the not only the stock but the option itself. So that is kind of like, I wouldn't say a red flag, but kind of like an alert saying, okay, so why would someone be buying this much volume in this particular option? So that kind of gives me a signal saying, okay, I'll try to research this company. I'll try to research the strike price and the expiration date. And I'll kind of build some kind of strategy against, like, okay, are they expecting a bullish or a bearish case for this particular option? Because if they're longing, say, for example, like 20,000 calls on the upside, then that's probably a bullish case for the stock to go up. And that's if, you can see if that's bought at the ask. If it was sold at the bid, so there's 20,000 on the upside, but it's being sold, that's probably a bearish case for the stock, but someone is selling a bunch of calls on that upside. So they're not expecting it to go, over that strike price, but below that strike price and just collecting premium. So that's just a kind of an example. So I like to look at the volume as well as open interest, because open interest is telling traders, this is how many people are outstanding holding the options. So
a bullish case, what do you do? Do you buy calls, or do you write a call or a put option?
So
what do you do?
Yeah, so in that case, I don't like going naked calls. I don't. I need to see a very, very convincing case, like tons of volume, but not only on one strike price, but several different strike prices, and maybe I'll go naked. But that's just too much risk for me. I don't want to just buy something and just if the spot price never reaches, the strike price, then you're kind of just out, right, of that. You just burn on that premium. So what I like to do is sell spreads. And if that's the case, sometimes I will sell a put spread kind of close to the spot price. And depending on the expiration date, I kind of will hold that spread for, forever or for however long until that's expiration. So selling that put spread is you're just collecting the premium, but you're setting aside a certain amount of capital as collateral if the case were to, if the stock price were to go down. So I like to sell spreads against that, yeah. But it just depends. It really does depend on the circumstance, because I think obviously the overall market affects the underlying stock, and you kind of have to not only see where that company, what's going on. Is it someone making a bullish case on a earnings call, or is it like the overall market? So there's lots of moving pieces that you have to assess before just jumping right into the strategy. So yeah.
Okay, so I guess I have an additional question, kind of based on what you just spoke about. So like for me, I don't really understand options that well. So I guess for the everyday investor, basically, why do you trade options? And do you think it's not for everyone, or if it is, why should someone like me or another average investor learn more about options?
Yeah, it's definitely not for everyone. I think they're obviously meant for asset managers that want to hedge positions on underlying stock. And it's just too risky for the normal day investor to be trading options, just because it is very, very complex, and getting into it, you have no idea what's going on, and you can easily lose money like that. And I don't recommend it to, like I said, just the normal everyday investor, because it's a level of risk that is just too high. So getting into it, I think the best way is to, first of all, own the underlying stock of whatever the company is. So for an example, let's just do Facebook, right? Or actually that's a bad example because their stock is pretty expensive. If you own 100 shares of, say, let's say, say like GE or Ford,
Okay.
because they're pretty cheap, right? So if you own 100 shares of the stock, my opinion or my recommendation would be, if you want to earn a little bit more premium or earn more of a return, I would say sell calls against your underlying stock, because that way, when you sell a call, you have the underlying collateral as the stock, but then you're collecting the premium that you sold the call, and that enhances your return. That would be the best way, I think, to get into options at first, is to own the underlying stock and then sell the option against your underlying. Just to see how it's like on the other end, instead of just going long on an option if you don't have any underlying.
I know it does require a lot of capital to write options, and Kenny, I remember you mentioning earlier before we got on the on Zoom about how you aren't necessarily a big options trader, but you were talking about how if you were to trade options, you would be writing puts, if anything. Can you talk a little bit about your mentality with that?
Yeah, so like kind of Azaan has said, I am not the most comfortable when it comes to options, and I can tell that Danny is very comfortable with it and has strategies, and I know there's proven like theories and stuff that works for options, given the data that you're given from maybe your broker and whatnot. For me, and I think why I said that earlier is because everyone's trading style is different, everyone's investing style is different, and everyone's risk tolerance is a little bit different. For me, in our age, my risk tolerance is very high, but at the same time, I try to keep risk management pretty serious. And I think that's hard in times, and I guess I'll talk about this later, because I think psychology comes into trading and investing a lot, and having like a strong mental fortitude and conviction in what you're doing. But I mentioned earlier that I would only be comfortable writing doing a put or writing a put option is because, let's say there's a stock like Lockheed who's like $350, right? Or 300 something. Let's say there's a put for it at like 250 a week from now. I can collect what's it called, Danny? It's called the
premium.
Yeah,
or
I can collect $40 or whatever on that premium, because I know fundamentally that stock's not going to reach that price. Or I'll look at the chart, or look at news, or see what's going on. Like, this is a strong company.
What if a hypothetical stock, was trading at a premium, and you wanted to own the stock at a lower price? you are willing to, buy the stock at a certain price below the premium and market value. So adding on to what Kenny was talking about, if you wanted to own the stock, just sell as many puts as you are willing to buy the underlying stock at, or you can afford, right? Or if you're comfortable with that. It's the best way, in my opinion, to, first of all, own the stock at the exact price that you want it to, if it does fall that much. Thank you. Yeah, margin of safety. So you can control your margin of safety if you just keep selling puts, and maybe, hopefully one day you'll own it, but then at the same time, you're collecting all this premium, right? If the stock is trading at a premium.
Yeah.
So
and I think
pretty smart.
Yeah, it's a pretty conservative way to invest. The other side of that coin, I would say, if you think the stock will go down, just don't do options. Just buy the stock and buy the underlying stock that does go down. Then you don't have to buy 100 shares of whatever.
Yeah,
you can't afford it, or you'll go broke doing it.
Yeah.
So I think the one side to it is if it happens to reach that value and you have to buy 100 shares of it, I hope you can afford it. Or so be smart about it in that way.
That was really good.
Just as like I don't know, it is kind of related, but you know how Robinhood traders have access to options trading.
Yeah.
And we all kind of know that Robinhood traders, I'm not bashing on Robinhood traders. I'm just saying, like, the majority of these people are first-time traders. Like, they're getting into investments for the very first time in their lives. And to have a tool like options available to them can be quite dangerous. I want to know your guys' opinion on that. Whether that, is significant in any other way or not.
Yeah, I mean, I can just start off. When I was introduced to options, it was actually on Robinhood several years ago. And the first time going into it, you have no idea what's going on. All these moving numbers, that's red, that's green. And yeah, I mean, I had no idea what I was getting myself into. So the ease of access was definitely very low. And I don't know how that's changed now, because I don't have Robinhood. So I just think it is, at the time, it was, thinking about it in terms of your question, it was pretty scary of having, just going into this platform of trading, and then you can just lose your money just like that. It's just kind of really, really crazy. But the protocol now on trading options has probably changed because of all these, you hear all these stories of, people committed suicide. And,
exactly. That's why
margin,
I brought it up. Yeah.
Margin, just and glitches, exploiting glitches and stuff like that. So it's probably definitely a lot, tougher to get into option trading. But yeah, it's.
I feel like I'm the in between. Like, if the options are available, I feel like investing tools should be available to everyone. If they have the determination and will to learn and understand it, then that's the power to them.
Yeah.
I think, I guess, when the time you started, Danny, they probably didn't have a warning. I think they have a warning now, or you agree to whatever happens. I'm not sure. I don't use Robinhood either, but I feel like play stupid games, win stupid prizes, as the saying goes. If you're not willing to, if you're gambling, then you're gambling. You should expect to lose money. You shouldn't expect to win.
So Jason, when you mentioned about how should people have access to trading options, the retail investor, of course they should. 100%.
Mm-hmm.
I don't think that there should be any restrictions on the trades that they can make. That would be completely unfair when it comes to the whole idea of the efficient market hypothesis. Everyone should have the same access to the same information, to the same trades. That would be like that would be saying only institutions should be able to trade options, only institutional investors, which would really pigeonhole, which would really pigeonhole these retail investors to moving with where the institutions move the market. Obviously, most of them are not informed. Obviously, most of them should not be doing these trades because they don't really know what they're getting into, which is totally fair. But I mean, I stick by the saying that when you win, you make money, but when you lose is when you learn something. So either way, the retail investor is going to come out on top. It's not up to the brokerage to suspend these retail investors and tell them what they can't do. It's up to the brokerages to try and help these retail investors actually take advantage of the market, that they can actually do something with it and grow their capital, which was what Robinhood was set out to do in their mission statement.
Yeah, I completely agree. Like every investor should have, access to exotic instruments like options trading, because every other brokerage offers it. So you'd be putting investors or your customers, I should say, at a disadvantage if you don't offer options. It's just my issue with Robinhood specifically is that I might get flamed for this, but they almost gamify.
I was going to say that. No, I was going to say
when they do the options thing. It's like you pick the option.
Don't they have like confetti?
I was just saying that.
Doesn't confetti or something happen when you buy your first stock? It's like congratulations.
And it's like you don't really realize what you've done.
it's getting people into investing. I think that's a good thing. Like think about growing up, how many people actually invested their money. Like look at today when the pandemic hit.
I mean, no doubt.
About stocks. You got that dude on the lacrosse team at Cal State Fullerton that he's out in the locker rooms all day. And I'm just making up some fictitious thing, right? Talking about stocks and talking about trading. I think it's great. The public will be more informed, and eventually it won't be kindergartners running around with scissors.
Mm-hmm.
It'll be kindergartners running around with a box of crayons. Sometimes you get messy, but you wash yourself off, clean up, and you're back in the game.
Yeah, I'm like, I feel like I'm in between you, Weston, and Jason. Like, I think there's things where for a certain consumer or user of Robinhood, where it's more of a risk to them than it is a benefit. But I think for a majority, the ease of access to a tool like Robinhood, like you said, Weston, is really beneficial because it does bring so many people into this realm of investing where, like I mentioned earlier, we don't learn when we're in high school. It's not something we're taught. We don't know how to be financially literate. And it kind of throws you into the ring, forces you to figure it out. Like, people are going to lose money, but that's the only way you will really learn. Like I've lost money investing a handful of times. And the only way you figure out how to not make those mistakes or why you've made them or how to make less of them is to continue to make them. And, some people, get a little too greedy and, throw all of their life savings into an investment and hope it works out. And I think that's why sometimes we hear these horrible stories. But that was a pretty bad decision if, you made that choice. Like in one of our recent guest speakers, Howard Marks, he said, bulls make money and bears make money, but pigs almost never make money. And, if you're a pig, greed is dangerous, and greed is a bad mentality to have when you're investing. And to tie back to what I said about having like the right mental, fortitude and having the right investing psychology, greed is a very horrible and nasty,
dangerous
feeling to have because it takes away from what the tool is meant to be used and how it should be to the exact opposite, I think.
Interesting. A lot of like cool opinions being thrown about like how brokerages should handle or should like I guess like should they regulate or should they not regulate? It's like really tough, but I guess it's always difficult to like to establish something in a consumer's mind that this business has your best interest at heart, because like that's almost always a recipe for failure. So like that's kind of how I see it, but it's tough to think that these brokerages have like our best interests and they want to like they just kind of want the most trades to happen. So
they are a business at the end of the day.
Yeah.
And it also reminds me, I think I tried to sign up for because I use Fidelity. I didn't want to trade options. I just wanted to look at Fidelity's options books, but I had to like sign up or like a request to be some sort of account, and I got denied. And I was like, really? Like, I was like, I've been with you guys for a while. Like, just let me look at the options books.
Was that just to access the tables?
It was like I was agreeing that I was basically saying I'm trying to trade options, but I can't look at the options books for some reason without being a certain account, which I guess makes sense. But yeah, it was just like a weird little.
Your risk tolerance is.
Yeah, I was like, yeah, I'm max risk. Check all the boxes.
Gotta get all that margin.
Yeah.
You're willing to lose 75% of your savings in a minute.
Yeah.
Now you can look at the books.
Exactly.
So I kind of wanted to switch gears if you guys are open to that, or does anyone have any more like things about options they want to throw out? No?
I just like that combo. That was a good combo.
Yep, I agree.
Yeah.
So I guess so since we kind of talked about like a lot of people have started trading, and the first thing people do when they do start trading is like kids running around the playground with scissors. But then one of like I feel like the most successful ways to learn about trading is through technical analysis. Now I know that Kenny, you do dabble in a bit of technical analysis. I've talked to you a couple times about it, and kind of random, but like I included it in my Chewy report, in a recent report, and I got like roasted by like the direct like
chewed out
the board. So like it seems like there's a lot of still like negativity around it, even though it like makes sense. So I just kind of want to know, like, why do you feel like it's important to learn about it, and why do you think people are opposed to it?
Okay, so I guess we'll say about to mention your Chewy report. I think when used correctly, it can be like a benefit. Other times it can be like a detractor away from, I think, your argument. But there's always been a clash between fundamental and technical investors, because one group thinks they're always better than the other, kind of, or they're more successful. So that's why I think people who are more fundamental investors versus technical don't get along. But I kind of see it like how you look at a value or growth company. Like sometimes you think it's one or the other, but they can really go hand in hand. And that's how I try to utilize technical analysis. And then it definitely varies on the situation. And there's also a lot of ways to like learn it wrong, or just think it's like a one-trick pony where it's a solution for everything. And I wanted to learn it the right way when I decided I wanted to figure it out, because I think there's a preconception that technical analysis is like, oh, you see this pattern, you see this happening, it's like, oh, you 100% make money. It feels like the shortcut to investing. And in some cases, maybe it works for someone where that just happens to be the case. But I think that's very rare. And it's not often the case. I don't know if everyone should learn it, because I think, I think it'd be great if everyone learned it, but I don't think everyone would be able to, because it's not impossible to learn, but I think it's, I don't know how to describe it. I think some people use it too much. And then they might forget about other ways of investing or looking at an investment idea. So I'm sorry, what's the other part of your question? I forgot.
I guess like it seems like more fundamental investors don't really like technical analysis. Like if it is implemented correctly, why do you think some people are still hesitant to accept it?
Okay. I think because like I said, people think it's like a one-trick pony. So when you kind of include it in a report or mention it, I think most people will get the idea. It's like, oh, well, this pattern or this technical analysis, look, it says this. But it's really not the case. It's like when you're making a fundamental case for a company, you're like, okay, these are all the catalysts, and then here's a risk.
Yeah.
If you just look at a company for what it is, it's, you're throwing a dart at a dartboard. It could go up, it could go down. You don't know until you do the fundamental work. Same with technical analysis. It could, like, someone's like, it looks like it could go up, but it could also go down. Well, yeah, no, duh. It's like, that's what investing is. Like, yeah, it could go up or yeah, it could go down. But technical analysis, I would say, is kind of similar to fundamentals sometimes, because you can look at a few factors and say, all right, well, this is what, X, Y, and Z are saying. Let me check my fundamentals and see if, some stuff can line up, and then let me make a decision. And that's how I would use it. And conjunction, because I think they could be a strong tool together. And I really think they're useful for like maybe entries and exits. And that's where I would really, see technical analysis being strong. But also it's like really helpful in understanding the chart, where you don't really understand it as much, I think, if you just only study fundamentals, because there's a lot you can learn from volume and certain price action. And I think people overcomplicate technical analysis a lot to say like, oh, I use this Fibonacci, or I use these moving averages of the RSI and the MACD and all these fancy terms. And it's like, yeah, that's great, but those only have a certain percentage of being successful. Going in the way in which you're trading. And most people, I would say, don't back test their trades or their strategies. So I think the simplest form of technical analysis is probably the strongest way to use it. And when I mean simplest, it's you want to look at the bigger picture, just kind of how you would look at the bigger picture, of a company. You want to zoom out. What has the price history been of this company? Where have its highs been? Where have its lows been? Where has it seen resistance? Where has it seen support? Where has been the heavy volume? And then I like to look at technical analysis and like psychology a lot, and I think they go together. So if you ever like decided to look at like a 1 minute or 5 minute chart, especially at the open of the market, you can see the way people are reacting to price action, because you can almost feel it. Like especially with GameStop, recently, and stocks like AMC, people get hyped on it. All this emotion gets into the market, and money and emotion should never mix. But when they do, it's kind of easy to predict how stuff will play out sometimes. And I'm not saying you're gonna like find a target for stuff, but like it kind of gives you an idea of where things will go. So like GameStop, I remember, went to like $60 or like 80, and then it dropped all the way to like 30 or 40. And some people are like, oh no, it's going to go to zero. But if you look at this volume and it's just been climbing, I think you can just look at this price action and say like, well, it's probably not going to zero, obviously, but it's also, everyone wants to hop on this hype. You can just look at this and see like within like the small candles, they kind of tell a story. And when stuff starts to like build off each other and candles and prices start to stack like whole numbers, very psychological, like 50, 55, 60. It almost makes technical analysis easier to predict, or not technical analysis easier to predict, but price patterns easier to predict, because everyone else is thinking the same thing. So if you're looking at like the history of like Tesla had a huge resistance between like, I remember like 200 and like 350 for like almost a year or something like that. Once it like broke outside that range of like consolidation, it had a huge run up to like, I don't know, like 700. So I think while technical analysis can be very strong, it's only strong when I think used the right way, and I don't think it's used the right way very often.
Interesting.
Sorry, that was a really long-winded answer, but it's like I feel like it gets overlooked a lot, and not many people understand it. I actually have this book here I always have on my desk.
Nice.
It's a technical analysis. It's called Technical Analysis of Financial Markets by Murphy. And what it taught me was a lot about understanding just the very basics of what technical analysis is. And like, I think YouTube's like kind of a bad place to learn actually, because I think a lot of people do it more for like entertainment reasons. And they have this idea to get views, and it's not the purpose of helping people. And that one trick pony kind of theme shows a lot. So that's where I think
get rich quick type of thing.
Yeah, exactly. Yeah.
I have one opinion on
Let's hear it.
technical analysis, and I mean, I'm not the biggest technical analysis guy, other than if I find an intrinsic value, you can use the technical analysis of the stock. How the price has how's it look in the history wise. You can see the resistance levels and support and whatnot. But as far as that goes, I think a lot of it is just gobbledygook.
No, I agree.
Yeah, waiting for patterns to form.
Yeah.
To trade, it's just.
It's overcomplicated.
It's just astrology for guys.
I'm gonna get burned for that. Dude, I 100% agree. I honestly, and I think the best way to really look at like a chart is you just look at where did it top out, where did it bottom, and then where was resistance. I look at things in like ranges rather than specific, I think, like targets. And then like actually the one time technical analysis kind of worked for me recently was in May of last year. I for the record, I was on GameStop before it became hype. I bought it last year at like $3 in May.
Okay.
And it was trading at all-time lows. It slightly dipped below its all-time low and then came right back. And I'm like, that was the bottom. Like, if there's any time to buy it, my risk is absolutely like zero at this point. If it goes to zero, then whatever. But that's when I think technical analysis can be kind of strong, because it's like the only history that this stock has ever shown is it's only gone down basically. So when you look at the chart, like, okay, well, it's at the bottom, you can still see at this line that it's at almost zero. If it breaks below this, then whatever. But if it holds, then there's some significance there. So I think the psychology of money and like levels of like whole numbers, past price history can give you insight to where you might see price in the future. That's where I do think technical analysis can be strong. It's just simple support, resistance, and that's it. Like, no trend lines, no triangles, just support, resistance, and what's the word? I just lost it.
Ranges?
Yeah, like ranges. Where there's like a lot of action. If you look at a stock that ranges for a while, just between like Netflix. Netflix has ranged between like what, 5 something and 490 for like weeks, right? That's like a resistance point. That's where consolidation. That's what I'm looking for. When price consolidates for a while in a certain range, like that area is significant to some extent. And it's not telling you whether it's going up or going down, but it's saying, okay, well, a lot of stuff's happening here, a lot of price action. That's when I would look to the volume, and the volume can kind of tell you a story. When stuff is like declining or increasing, it'll begin to tell you whether a certain level becomes stronger or weaker. But that's the only time I think technical analysis actually really has some value, because like you said, Daniel, a lot of it is hoopla, and a lot of this stuff is just, I think, for show. And it only really works on smaller time frames as well. Longer time frames, I think technical analysis can be so-so. That's why only horizontal support and resistance is really, I think, the most important thing.
Okay, I'm definitely like rethinking my report right now because you said a lot of useful stuff right now that like I had no idea about, honestly. Like,
Yeah,
pretty interesting.
It's not complicated, but it is. I just think it's overthought.
Gotcha. Okay, thank you for the insight. I think Weston has one more question, and then we'll let you guys go.
So Kenny, it seems like there's been a theme with what you've been talking about, like an underlying theme with what you've been talking about this entire podcast. And it comes down to the psychology of an investor, the psychology of a trader, the psychology of money. That's the psychology is what I keep hearing come up when you're speaking about, what positions you've been taking and how you sort of think about the stock market. And I was wondering if you could expand a little bit on your thoughts on the psychology of investors. Mm-hmm. And Danny, I know you have some thoughts on this as well. So I'd like you to join in after Kenny lets us know a little bit more about his thoughts on the whole psychology of an investor.
Yeah, that'd be great. I'll keep this one a little shorter. I think why I bring up psychology frequently is because there's just something about investing in money and like people where it's easy to like fall prey to a lot of stuff, or it's like easy to like with Dogecoin and all the hype on that, or GameStop, COVID and people investing, these waves of investors, that doesn't just happen because there's like opportunity everywhere. It happens because everyone has the same sort of mindset. They think I can make money here or whatever it is. So like, for example, when my roommates will say something about, have you seen this stock? I'm like, okay, well, that stock's clearly popular enough where it's caught their attention. Now, how they act on that gives me insight to maybe how this stock will perform. So if, my dad says something to me who's pretty, watches the news frequently, likes to invest, mentions something about a stock to me, like, okay, there might be something going on with this company, or something might be going on. Whereas when it's say like a roommate of mine who just does like criminal justice mentions a stock to me, I'm like, okay, that's a little less, that there's something more telling there. When you see it all over social media, that says something about everyone's mindset about maybe a certain topic. So I think in that aspect, psychology is important because it signifies the sentiment of the market, and I think sentiment's very important. Like where we are currently, I think sentiment's very important to keep an eye on, because a lot of people are saying, oh, we're going to crash soon, we can't keep going up forever. Whereas you have some people say like stocks only go up. So it's like that you can't really track, I think, and you can't really measure. It's more of like a feeling. So I think I try to keep a mental note. Okay, how am I feeling as an investor? If I'm feeling this way, a bunch of other people are probably feeling that way too. If I want to FOMO, probably that person wants to FOMO. When people start talking about stuff, I think that gives me a lot of insight. But then on a more individual level, when it comes to how I invest, I know I can stomach a loss and be okay with it if I know it's just, I'm temporarily underwater. Whereas some people, I think they would either cut their losses quick, but maybe they're selling at the bottom, whatever that might be, whatever they're investing. So I think it's really hard to be aware of your own mindset, feelings, and emotions when you're investing. And I think it's important to keep track of that, maybe in a notebook if you do it often. but also be aware of a lot of people around you. Because I feel like right now the market's very hot. Everyone's talking about it. You know, your friends who aren't, I guarantee your friends who aren't in finance are talking about it with you too, right? Like, but that wasn't happening a year ago. You know, that wasn't happening 2 years ago. So something has changed, something has shifted, but what, why? How long can that last? So I think stuff like that's important to keep attention to. And that's why when I mention psychology, I think money and psychology is very interesting, because the dynamic it has is unlike a lot of stuff, because greed and fear are really strong emotions that can dictate what people do with their money.
Yeah, and to add on to that, you know, we've read the book, you know, by Howard. Is like, he's the ultimate, you know, he's the godfather on psychology and investing, right? And going back to last year, you know, the market is like a pendulum. You have two extreme sides. You have, as you were saying, Kenny, extreme fear, and then you have extreme greed. So, you know, it is really important to look at the market right now, and you see all this exuberance in the market. Everyone's talking about it. Everyone needs to buy in. You know, every single day, the market's hitting all-time highs. And Howard Marks is always saying, you know, you take a step back and you look at it and you say, why is this happening? Should you be the opposite? You know, is it a good time to be the opposite of what everyone's feeling? Because that's the contrarian view, right? So it's whenever you make your assessment on the market, you know, should you jump in with everyone else, or should you, like I said, be the opposite or be a little bit more cautious, you know? And there are different metrics on trying to kind of like quantify everything, and come to what is the market consensus on, like, you know, fear or greed. You know, for instance, how much of the S&P is hitting all-time highs? Like, I think that I already said that, but every single day, how long has that been happening? You know, and you can kind of like get your own assessment, is like how much greed is actually in the market. And you can use that to your advantage, and you can use that to inform other people. So.
And I think a great example would be, you know, the March 2020 sell-off, when COVID, you know, first came. You know, markets were selling off hard, like free fall. I think it even triggered like this thing that stops market for a while.
Oh yeah,
like, yeah, it stops trading.
Yeah, it was
it's so bad.
Thing.
Yeah. And so if you were on the opposite side of that and you were buying in, you'd be literally anything you would buy, you would have made so much money to this day. All right, so with that, we are running low on time. Thank you, Danny and Kenny, so much for joining us.
That was fun.
Yeah, we really appreciate you coming on, and we will see you guys on the next episode. Thank you.
Thanks.
And that's it. Fade to black.